Uh, Okay, what's up, guys? Welcome to our weekly night. We're going to be talking about macro and kind of business models today. Jason and I actually presented this to the EMBA cohort on Monday, and I think it went down pretty well. So wanted to share that with you guys, and feel free to interject at any time. We have like a case study on Curve, which I think is pretty cool. But if you have like any questions or anything, go ahead. Okay. Can everyone see my screen fine? Sweet. Okay, so macro. This is basically the outline. Jason, do you want to say stuff on this, or should I just go ahead?
You can definitely just cover whatever you can cover, and then if you want me to step in, I can just cover whatever you might not have in mind.
Yeah, okay, bet. Yeah, so this is basically what we're going to go through today. So just the overall macro thoughts on crypto. So price movements, what's going to happen here, kind of like our thesis on what's going on. Then we have this Web3 crypto section, which is pretty cool. So basically, the idea of Web3, the idea of DeFi markets, and then Curve being a Web3 business. And then, yeah, you guys will see what's happening here. Okay, so the most prominent thing and the biggest narrative at the moment is interest rate hikes. And yeah, this slide is it basically summarizes it all. So the Fed, Jason, do you want to present this?
Yeah. So just okay. This slide is a bit opinionated, so it's actually less of what we usually do, which is just present facts. But this kind of is a bit relevant since it's nice to provide color on all the stuff we talk about. As you guys may know, the Federal Reserve controls the monetary supply of the dollars in circulation. As a result, what they do impacts the economy much more than almost anything else, outside of pandemics and so forth. Their job is to manage and keep two things. One is inflation manageable, and then the second thing is make sure people has jobs. Their job is it's a twofold mandate. The Federal Reserve actually has this written into their mandate. So that's the purpose of, or the justification of why they do what they do. And so one thing they do, one of the levers they're able to manipulate for managing the economy is the interest rate. Specifically, the interest rate for borrowing the cash from the central bank. And what the result of this is that banks are not allowed to borrow from each other underneath the interest rate set by the Federal Reserve. For example, if the interest rate is 1%, then interbank lending, in other words, loans between banks must not go below 1%. In other words, the cheapest cost of borrowing has to remain at or above the interest rate set by the central bank. Normally, this rate stays within the single digits. It's an annualized rate, right? So 1% would mean 1% per year, i.e. if you, as a commercial bank, went to the central bank and borrowed a sum of money, you'd be paying 1% from the central bank itself, which commercial banks do with their accounts at the Federal Reserve. The reason why rate hikes or just interest rates in general are important is because they control the flow of capital in the economy, and as a result, they have a heavy impact on asset prices. The cheaper capital is to borrow, the higher generally asset prices are. This is a result of the fact that equities are, in essence, instruments that are speculative on future cash flow of businesses. At the end of the day, right, the equity entitles you to ownership and future cash flow or dividends of the business. If capital is cheap to borrow, that means the business can expand quicker and have higher revenue in the future. If capital is very expensive to borrow, the business does not have as quick or as economical avenues to expand. As a result, the asset prices are lower because the future cash flow of the business would be lower since it's more expensive to borrow and grow. The narrative here, or the thesis we're trying to just provide some color on, is that in context with the global macroeconomic environment, what will happen to equities, crypto, and macro as a whole is that what we're saying is The Fed will obviously hike rates or increase the interest rate during election years. This is the primary example. This is one of the primary tools to combat inflation. As a result of the election cycle, voters are not necessarily too pleased if they have to deal with increasing inflation. One of the simplest responses is to vote out whoever's in power that let this happen, even though the results might be latent due to these effects happening, the cause of these effects happening, either months or years ago. But anyways, the idea here is that the party who's in power, in this case, the Democrats, are actually the ones who appoint the chairman of the Federal Reserve. So the head of the executive branch has the power to nominate or fire the head of the central bank. As a result, the central bank is under bidding to do what the executive branch would like, although they are not required in any means to follow it to the T. They have room for interpretation, obviously. What the thesis here is saying is that, and this is sort of a personal opinion, also just a thing that I have also seen, is that the forecast here is that the rate hikes will happen maybe twice during this year. The more aggressive the Federal Reserve is at hiking rates, the lower the bigger impact it will have on equities and thus crypto prices. The reason why the Fed will need to keep hiking rates, right, is because of this inflation problem. However, the core insight here is that once the election season is over, they don't actually necessarily need to keep hiking rates. This is because of the voter base. A lot of Americans' wealth are tied up in their 401ks, retirement accounts, and primary residencies, or other pieces of real estate. These all correlate with interest rates pretty heavily. Normally, people don't like to have their property and their net worth, plummet for no reason. As a result, in order to keep everyone happy, the most, agreeable solution is just to keep interest rates at a low value. Right now, it's at 0%. So the prime rate that commercial banks are getting for capital is actually just 0%. So they actually are able to borrow money for free, and they're able to just lend it out as they wish. This works its way down the chain. Some of the banks you might get a mortgage from, or retail banks, they might offer you 3% on a like 30-year or 15-year mortgage, which is considered prime because you as a consumer do not have the borrowing power or the connections to borrow directly from the central bank. It makes its way down. It's tranched up into various different financial packages and services, which eventually makes its way to the hands of the retail consumer. So this is how the banks make their revenue. It's off their interest payments. And this is how the consumer kind of gets the worse end of the deal, if you will. Although the bank lending to the consumer does take a risk that if there's a bankruptcy, which is very forgiving in the US, happens, the bank is on the hook. So you pay your 3% interest rate over whatever many years, you get this large sum of money, and then the bank just profits out the difference.
Jason, they also, it's a way to bring back capital, no, to the central bank.
Yeah. So, that's one point I actually didn't consider. That's a really good point. So if interest rates go up, the monetary supply and circulation goes down because it's more expensive to borrow. Some commercial banks and others are less incentivized to borrow a large amount. And then just to wrap up this kind of slide, our thesis here is that at least personally, capital will remain cheap over the next 2-ish years, seeing as after an election year, the incentive exists such that they don't actually need to keep rising interest rates to combat inflation. The primary thing to examine here is that it's inflation rising versus equity prices dropping, right? So inflation control versus equity prices having to take the hit, right? So the idea here is that if you're running the central bank, you actually have the choice to either combat inflation at the expense of equity prices or keep equity prices as they are, but allow inflation to run a bit higher than the target, which is what we're seeing right now.
Yeah. Jason, just wrap it up, bro.
Yeah. And then one other thing is that there's a lot of narrative-based investing in crypto. It's being used as a hedge against fiat monetary systems. One other point is that cash flow is a lot of cash flow in DeFi is being supplied by the issuance of new governance tokens and new protocols. So it's it's still a very young industry. There's a lot of speculation going on, and we haven't really seen the winners yet.
Yeah. Okay, so this is CPI. This is the new rates, and it's interesting. So we have basically the index, so all items is 7% at the moment. And we have the individual makeup of these things over here. One thing that is not here that I wanted to show is coffee is 93% up year on year, which is kind of mad. And they've been changing the weighting of this basket like as they've been going. So that's interesting. And you can, read into what you want to. Couple of interesting things is that the linear inflation increases are these things. So food at home and food have been going up quite steadily since 2017, which is kind of mad. And yeah, inflation is happening. So then we have the interest rate kind of thing that's going to happen now, as Jason was saying. And yeah, okay. So that's CPI, and that's inflation. And then how does that affect kind of here? So if they raise interest rates, obviously things are going to go down. But so currently, let me just step back a little bit. So currently what we have is we have a large correlation to equities as it stands. So I don't know if you guys have noticed, but the S&P basically and Bitcoin are the same thing at the moment. And we have a Pearson coefficient of 87 basically percent, the R factor there, which is really, really high and a positive influence. And kind of what this means, right, is if you're looking at Bitcoin, you're looking at these things, is that the way that the market is working is that the market participant that is buying and selling the S&P and the NASDAQ is the same one in crypto, and they have equal power and they are acting like the same, which either means that everything is a scam or that people are investing in risk on assets in the same way. So I think this is interesting because crypto shouldn't necessarily be in this category. So there's kind of an alpha play to be played here in that Bitcoin's inception is risk off. So there's kind of it shouldn't be, and there's a strategic incentive there to play that alpha road. So we can bet on a decoupling, or but that sounds pretty scamish, but we can bet on a decoupling. I think I added these in, which is pretty interesting. So I was looking at the 3-minute chart when I was when the crash happened, or for a recent amount of time. So the orange graph is the S&P and blue is Bitcoin. And you can see here, so from 4:30, right? It's the exact same chart, which either, so there's bots or whatever that are exactly trading Bitcoin and the S&P on the 3-minute chart, which is kind of nuts. So should this be the case? Probably not. And I think if Bitcoin gets big enough, we might see a decoupling or just an uncorrelation to whatever's going on here. Because I don't feel like the valuation is based on inside crypto, but it's rather based on this larger risk on, risk off market. Then this is interesting now in that this is the 1-hour chart. Again, S&P is in orange, Bitcoin is in blue. And you can see at the CPI, there's kind of a divergence. So recently, when the crash happened from 67K, it was also on CPI day. So we just had a crash right now, but also on CPI day. And kind of at the initial announcement of CPI, there's a divergence. S&P down, Bitcoin up, but then Bitcoin always gets dragged down. So I think it's hinting at a divergence in thought, and these actors that are making it the same thing are getting weaker. So yeah, those are my views. Does anyone have any questions on that, thoughts on that?
Any questions, if I could ask?
Yeah.
So when you're looking at this in terminologies of correlations, how does adoption play a role in this? Because certain events are happening, right? That's affecting the models and charts
Oh, you cut out, bro. But
for specifically. Is it because Bitcoin is obviously highly correlated right now just with traditional equities, since it's being valued as not really a hedge against inflation, but people are just buying it as an investment.
yeah,
There's a
yeah.
lot of speculation, I feel like I get into like VCs and whatnot, but yeah, like until the day that we can go to a supermarket and use Bitcoin, like how correlated do you think it will be?
So that's like that's exactly what I'm hinting at. So it's like the Ethereum price is not actually a function of Ethereum, and there's no like relation to like transactions processed per second, value transacted per second. Like there's nothing about Ethereum that plays into its price. It's kind of this like speculative vehicle, as you say. Same with Bitcoin, same with all of these things. But like Bitcoin is designed to be a hedge against inflation and all of that. So I'm obviously, if I knew when the decoupling would happen, I'd be the richest man on earth. But like, I think I'm just pointing out that there's a, yeah, exactly as you say, there's a bet to be made on, because it's not fundamentals based. It's like this larger speculative boom, and it's far easier to just trade money flows than it is to trade like, I don't know, Ethereum is launching a new improvement protocol. So yeah, but to answer like when it would decouple, it would probably be when the liquidity in Bitcoin is far larger than that traded in the S&P.
I would actually tend to disagree with you on that. I feel like all markets are pretty much just a matter of perception of the asset itself. Like the price is just dependent on perception, and until perception changes, I feel like what you're saying is correct, but like underlying, if people perceive it as valued based on transactions processed per second or the technology, then that's what the price will reflect. But I think it's all just based on what everyone thinks.
Yeah, exactly. It's a narrative game, I think. Yeah, exactly. Well, I think we agree. That's what it's kind of what I'm saying.
Yeah.
But yeah.
So is the only way to profit off of this by predicting narratives? Is it just a game of predicting narratives?
So this is to profit off of this, you got to have a very long time frame. Like the point is that the fundamental in core of these assets is not being valued. Basically, you first have to agree that capital markets at some form of level value the asset at the asset in some kind of way. So like the thing that I'm going to point out next is basically this point, in that if you have a very long time frame approach to these things, Bitcoin is roughly the same asset as it was, a long time ago. And it was used by like drug dealers and whatever. And to profit off of that, if you think Bitcoin is a hard form of money, and you see it in Silk Road Bitcoin, but it's the same thing now. And now it's like an institutional grade of, in like store of value that people are putting $2.5 billion worth in. Like there's profit right there. So like if your time frame is long enough, and like I think like it's fine, like 10-year, 20-year kind of horizon, it profits quite well. Codes, I think we're going to move on, but that was nice. Ivan in the chat, how long has S&P been coupled with Bitcoin? So the correlation coefficient that I ran there was the last 1.5 years, I think. So it's fairly high. Yeah. So like year to 2 years. So exit strategies, this is pretty technical as well. The first three. Again, it's Jason's slide, but Jason, do you want to talk about the first three?
Yeah, just briefly. So if you invest privately, you have three strategies. You can either get secondaries sold next round. If you invest in a project that raises future funding, you can wait for the token launch, and then you have tokens that are liquid, or you just write it off. And then
Bet. Okay. So again, it's basically what we were just talking about, price, being price agnostic, and it being plus EV. I don't know if you guys know what EV is, expected value. It's basically like it's the expected value that you expect to get out of a trade, or like a like a price movement. So what it is that you take in so let's say that I have a coin toss, and the expected value of that, if I get heads, is 0. So let's say 1 for winning and then 0 for not winning. So you take your expected outcome, so like 1, you multiply it by your probability, so 0.5, and then you add it to the expected value of the other one. So like it'll then be -1 times 0.5, and your EV is 0. It's basically like a probability weighted outcome. So it weights increases and decreases to the probability that they happen. And my point is that this is not caring about price is the highest. It's the way that you can expect the most value. I'm sorry if I didn't explain that too well, but yeah. Cody, I'll get around to it in a little bit. Let me just finish this quickly. So these are examples of these things. Solana, for one, in that if, this chart, it looks bad now, 250 to 100, but the thing is still up 22,000% since like over here. So it really depends on your time frame, your preference, and obviously this happened far over here, but if you are agnostic about price and you think that this asset is a good asset, then you have, won. And the next one is pretty cool. So Mana, I don't know if you guys have heard about this thing, Decentraland, but it's like this metaverse, one of these metaverse companies. And this is November 2017 to April 2018. So basically the first bubble, which is kind of cool in that. So it went up to 25 cents. It came down all the way to like 4 cents. So you lose like 80% of your wealth in the course of like a year and a half. It's really horrible that. And I mean, it just goes down only. And this is the Mana chart now. I don't know if you guys have seen this, but what I just showed you, that time frame is this period here, right? And this is the same. It's the same thing, right? You had like, I don't know, 4 years to invest in Mana, and like we didn't. So but if you knew what Mana was valuable to be, and if you know what these guys are doing, and then you're up 32,000% from the top of 2018. And my point being here is that this is far, like this happens like far too often in crypto, in that the nature of the assets that we are investing in they have this just an infinite upside. So the EV is there to be extracted. Yeah, I think we all know this meme, QE. There are thousands of coins that are never recovered, David. Yeah, sure. But the fundamentals were probably not there. Or I'm just pointing out that plus EV. So like spray and pray, I guess. And this money printing thing, hedge against inflation, obviously. I think we're fairly comfortable with this meme, so I don't think we need to run through it again. Cody, did you want to say something?
Yeah, I just wanted to ask you about pricing in and just how the market prices in new developments, because how can we perform a fundamental analysis when the asset that we're analyzing is changing and developing, especially so fast in the space? Like, yeah, we could buy Decentraland back before the first peak and then have sold it. Like, you know what I'm saying? I don't know if that makes sense.
Kind of. I'm just like saying, so like take Bitcoin, right? It's the same thing. I mean, it has like Taproot and it has like a couple improvement protocols, but it's the same thing. So if you knew what Bitcoin is valuable to be, and if you gotta have like a philosophical thesis on the thing. You got to believe.
Yeah. Can I ask you about Ethereum, for example, then? So let's say Ethereum's value is based on its utility as gas on the network. So like every time a new protocol is created on Ethereum, then doesn't that change the fundamental analysis of Ethereum itself? Like we can expect the value locked in these protocols to go up, which will hence liquidity flowing in will increase Ethereum's value. Like, can we assume that?
I think you're thinking about it too. So my timeframes are too big for that. Like, I think you're trying to trade like a 1 month kind of thing, but like the Ethereum's is value is not in gas. It's more in like the philosophy of Ethereum, in that you now have like a transactional blockchain, right? So like it's the first one that does that. So that is Ethereum's promise. And like Solana is like transactional blockchain with like speed and like with centralization and whatever is not necessarily like the specificity of the thing, but it's like the function case of Ethereum. Like, what does the white paper say? Does it achieve those things? Like, that do those things matter in the long term time frame? Which is kind of like mana, right? Like, I don't know what the white paper says, but I imagine it's kind of similar to what they're doing now. So if you thought like the philosophy of what mana are doing is correct, then like, it's fine. And we move. This is kind of interesting in that, so this is, I think we're familiar with this, but it's crypto to an MBA person, it's 24/7, there's no sessions. We all know about weekend liquidity, I think, but that's kind of the effect of there being very dry books on the weekend. So you see prices moving quite hectically, which is not something that you see in normal markets because everyone's awake and everyone's trading the open and the close. We also see Eastern selling, Western buying. So like China wakes up and then the price goes down, which I think there's actually, if someone could like do a calculation on the amount of value that's been transferred from the West to the East by that, it would be like really interesting to see. This last point is my barber, it was Nigerian, he's back home. And he was telling me that like on the streets, they don't use Naira to transact, they use Bitcoin. It's like if you wanted to buy like a packet of crisps on the street, you're using Bitcoin and you're using like it's called Luno. So you're trading on the exchange, but they are using Bitcoin to transact. And 32% of Nigerians that answered this survey have used cryptocurrency before, which is kind of it's kind of mad. And then there's this IMF thing about the financial stability challenges that the crypto ecosystem presents, which is kind of interesting. Yeah, I guess this is a Hopian presentation, so I hope you guys are enjoying. We've seen this. This is Uniswap, decentralized exchanges. Jason's run through this already. So if you want to hear about this, we can you can watch the other thing or something. But basically, constant product rules, Uniswap, decentralized swapping. It's an automated market maker, and there's no limit order books, and basically the limit is at current price, and the liquidity is at that current price. And then this is what I have to say about that. So what we were talking about to the MBA folks and stuff like that is that, like, basically we are new into the workforce and you have all of these traditional business models that are out there. So you have like, and I don't know if you guys have ever taken a business class or or if you got any of you guys are like econ majors or whatever, right? But you have like very solid definitions of current business models. And it's like the way that it's taught, like macro, market, micro. And then you also have your key stakeholders in your business. You have the customer, you have your shareholder, you have your employee, then you draw analyses to all of these things, you make all of them happy, and you kind of like maximize that, you move forward. In Web3, I feel like this changes in that, like, if I am if I'm a Uniswap, if I use Uniswap, and if I also provide liquidity, and if I hold the governance token, then I'm all of these three things at the same time. So we have like business models changing. And I don't know how interested you guys are in business models, but this is where we're going for the rest of this thing. Kind of like the structure and, how these things are made, and like, what do like we look like in them? What do customers look like? What do users look like? And, like, what is that? What's happening here? This is an interesting perspective, I think, to view things in. So my point over here is that, so Web 1 is read, firstly. So we read. Web 2 is write. We're all familiar with this. Then Web 3 is this new thing of own. Now, what does that mean? Is it just a meme, or does it actually mean something? So this is what I think is happening here. So in the right section of the internet, you get the creator economy, which we all like see a lot. Everyone is posting on YouTube. Everyone is posting on Instagram, and you have all of this content in the world that like individual people can produce. Everyone is a creator. Everyone's a developer. It's all happening. And in Web 2, we have these entire social networks that are based on people making content and people viewing content, like Instagram, right? And what tech companies do is that they host this content. And they are the only people that get to monetize the creation and the viewership of content by people. So Instagram, for example, right? In the beginning, they had like a good protocol, and like Facebook as well. So a lot of the value is in like the code of Facebook, in that it's new and it's like, it's very cool. But like you come now, right? And like Instagram is not so valuable to us in that it's like, it's got like, it's the best app to use, but it's just like, we use it because it's like where other people are and like all of that other stuff. So the value of Instagram is placed outside of Instagram, and it's placed in like us, right? So the tech companies monetize our network effect without it being us. And we're not involved in that. And I think at a philosophical level, Web3 changes this entire incentivization structure, in that like users are now active participants, and investors, and like / all of these things. And there's a lot more power placed back to people who make the network effect valuable. And we don't, obviously, there's nothing that does this quite so well right now. But I think the basis points of Curve, Uniswap, they do it in a kind of way where there's a lot more power to the people, and you don't have the solo monetization structure of all the value just flowing back to 10 companies and like a minority of people becoming rich. And I don't know if you guys read Kobe's article on Twitter, but this is where this came from. And like, I don't know what Web3 is, but also no one knows what Web3 is. There's 30,000 votes between these two polls, and one says Bitcoin is not Web3 and Bitcoin is Web3. So I think Bitcoin is Web3. I don't know if anyone has any differing opinions to that. But yeah, we don't know what this thing is defined as, and there's a lot of, it's a new thing, and that's my philosophical view on Web3. Does anyone have anything to say on that? Perhaps. Yeah. Okay. Okay, bad. So this is interesting. If any of you guys are econ, it'll be fun. But this is basically valuing DeFi protocols. And is any of the things that traditional these stock guys, is any of it useful? Is any of like macro, cash flow stuff, it doesn't make sense in cryptocurrency? Can we use it? Is there alpha in it? The PE ratio, no, okay, I'll show you now. So Curve, I don't know if I think you guys are familiar with it, but it's basically Uniswap with very low slippage. And that's the USP. And yeah, so DEX with low slippage. And this analysis is not done by me, it's made by this guy, this Masari guy. So credit to him. And then if you guys want to like read into it more, the link is there. Okay, so DEXs in general, what happened last year? So they transacted over $1 trillion of value in 2021, which I think is kind of nuts. And Curve has an 8% share in that, and they have 20 billion in TVL. For some perspective, Binance traded $7.7 trillion last year. So there's a lot more growth to happen here. Yeah, 7.7 trillion. Then we have this Curve token, which is the income source, and it's what we're going to use to do these analyses models. So this is like the Curve token. We all know it's a governance token. You get it through the free market or by providing liquidity. And then the Curve token has various use cases. So when you stake Curve, when you lock it up, you get VE Curve, vote escrow. And then you can access these three things: voting, staking, and boosting rewards. Voting, you can vote in the DAO. And staking, this is the interesting thing, is that the people that stake their Curve share 50% of the trading fees. And then you can also boost your LP rewards by staking your Curve tokens by up to 2.5 times. So we're going to use this 50% of all trading fees part of the things. We're going to use the trading fees generated by Curve to do these discounted cash flows and stuff. Okay, so discounted cash flow analysis. I don't know if you guys know what this is, but this is it's basically the hardest thing that any valuation, people speak about this all the time. And what it does is that it basically says the future value of my cash is this much. I'm going to make this much on this investment, or rather this protocol is going to earn this much in revenue. And then, wow, I'm not explaining this too well, but like it's basically the future value of cash, and it's a way to value things. And I won't dive into it, but if you guys are interested, you can check it up after. I'll just run you through some of the things that we put in to get the curve valuation over here. So this is a low growth scenario, and to do a DCF, you need to calculate a year-on-year growth rate for curve. So this one is 100%, scaling down to 3%. So starting in 2022, it's 100%, then it scales down, whatever like this is, to 3% in 2026. Low growth at 100% this year. And this actually is low growth because it's like a third of what's happening at the moment. Like they grew 300% last year. So yeah, market share 9. And we're basically taking the total DEX volume, which is also growing, 1.9 trillion, 2.7 trillion, 3.3, whatever. They own 9% of that. Total fees to curve holder. This is a curve thing. Terminal value, we don't need to worry about that. And then the discount rate is 20%, which basically means that your like opportunity cost is 20% per year. And then that's what we're going to use to like value like what's going on here. And after all of this, we get a curve price of 0.86%, $0.86, not percent. So 86 cents. The current price is $3.50. So yeah, cash flow say it's worth 90 cents. The only model that this thing works in is if you put in a growth rate of like 450 or like 350% in 2022, and then have it scale down. And even there, it's only at fair value at the moment. So yeah, the DCF is a weird way to go. Yeah, so we'll get it curve wars. So okay, this is now PSPE. I haven't even talking about that, but basically, if you the issue with I mean, I'll just explain what's happening here. So it's price to sales. So sales is now trading fees that's getting here, and yeah, your price, and then this is it's just that divided by that. So Uniswap trades at a 12.5 times thing to sales, which is actually pretty good. So is SushiSwap, but they've done this. It looks this good because of like the way that the tokenomic structure has happened. And then you get Balancer at a 68.8 times. Like if you see this ever in stocks, you're gonna short the hell out of that. Average is 28 points. Curve trades at a 76.6%, 76.6 times to sales. So like this is like what is that? That doesn't tell you too much, right? It's basically this is a lot larger than SushiSwap. So this one tells you that SushiSwap is a lot more valuable than Curve, or like it's undervalued compared to Curve. Does that make sense? We'll get to that just now. Dividend yield as well, which is basically you hold a certain value of tokens, and then you earn trading fees, and then this is your yield. Again, it is the second worst. And then we have comparable valuation. Again, EV, implied price per curve. It's basically saying Curve is overvalued compared to its peers. Yeah. So
how do you price in different chains? Because Sushi is cross-chain, whereas
so I'll get to that just now. It's basically my next slide. So why are these things telling us that we need a short Curve, even though that does not make any sense, right? Is it vastly overvalued compared to the market? The answer is probably no. Like it's probably not too insanely overvalued in terms of like fundamentals and the narrative case and like tokenomics and all of these things. And my point over here is that traditional valuation models no longer make any sense. So you can no longer run a discounted cash flow. Like, I don't know if you guys have heard of Warren Buffett and stuff like that, but this guy was like running DCFs from his like his dorm room or whatever, and now he's like a billionaire. And he was like, I swear he said it somewhere that if you like do that, like there was that much alpha in like doing a discounted cash flow analysis, and it's still like how Berkshire and stuff make money. If you do that here, you're going to become poor. Like, there's no way that's going to work. So like, why does it not work? And it's because we have narratives in crypto. We have variable lockups in VE curve. We have again, voting power boosting. We have all of these other aspects. Like, you own tokens, not just own trading fees, but it's now a political thing. Like, how do you price in politics into like that kind of thing? And all of these models, it doesn't process that, like just by design. And that's where I think they are breaking. So I think curve is valuable. So we have this curve wars narrative strong right now. Convex. Does anyone want to say anything about that? Any questions? Ivan, why do you think it's useful? So we go to. So what does this tell you? Useless governance tokens.
I think it tells us that it's more complex and no one model really fits all scenarios and can't be relied upon.
Yeah. My point being is that you can't run a discounted cash flow analysis and then have any actionable intelligence. Like that, this tells you nothing. Like,
can you talk about DEX tokens that have a buyback model? I think that might apply to some of this, like Trader Joe on Avalanche.
Buyback models, like burning?
Well, not really burning in a sense, not sending them to dead wallets, but there's a DEX on Avalanche called Trader Joe, and transaction fees from the DEX are used to buy back the DEX's token. Well, that can be staked on the DEX for APY.
Okay. So, like, you're asking how that would affect the models?
Yeah, just looking at the curve token versus a token with that model.
Oh, like how
like,
I would value that? Okay.
And then there's like tokenomics versus the protocol's utility, right? Do those always link up and match up? I mean, you're saying in the long run that things will rationalize, right? That's been your argument.
Yeah. So I think so I guess that's not kind of completely related to what's going on here. In that, like, so I think in crypto right now, narratives are literally the only thing you need to like farm. Like, that's where all the alpha is. You chill on Twitter and then you get like yeah, it's a very narrative based game right now, and there's not much theory to apply. Rather, you just farm what goes on. So it's like, you've heard the meme Avalanche season, Solana season. Like, what does that mean? It literally means Solana narrative season, Avalanche narrative season. So you buy Trader Joe when the narrative of Avalanche looks good, and you buy ETH or whatever, and you farm the narrative. So I
wanted to ask you about Avalanche in particular because of the subnets and for gaming, if gaming's the next narrative.
Yeah, gaming is weird for me. I think it's like it's rarely reflexive. I think honestly, for gaming, you can just look at the how much money they make people, because it's fairly good in that, like, the what's that one, DeFi Kingdoms? Like, DeFi Kingdoms, you could value it in that, like, the NFT that it produces are like kind of good. How I value Avalanche on like a gaming.
I just meant the capability of Avalanche Network to host games using subnets, where it's like a game designs its own blockchain, because Avalanche copies the EVM from Ethereum, I believe.
Yeah. I mean, I guess there is value there.
In terms of fundamentals,
Yeah, and I feel that. I think there's value there. I don't know. I don't have too much to say on that. I'm not like so familiar as to what's going on with like subnets and stuff. That is like the USP though, right? AVAX, that's what they do. Subnets.
My vague understanding is that a subnet is a multi-blockchain connection system where it functions to solve some of the problems of Ethereum. That's pretty much all I know about it.
Okay, that's fine.
Like a game can go on Avalanche, build their own blockchain, then connect it to the Avalanche blockchain, and have them co-interact, allowing for gaming.
Okay. Okay, cool. So yeah, some questions in the chat. Let me get to them. So did we?
Just to comment on that, I don't think gaming is the next narrative. I think gaming is the current narrative. I think if you want to look for the next narrative, you have to look for something that's completely out of fashion right now. So just a trend on that.
Jason, what do you think it is? Shill us your bags.
If I had to guess, I could guess all day, but
okay. Okay. In the chat, so do we need new M&A models for ERC20s as shares? Also, technology is very nascent as it's more VC-based investing. Yeah, I think that's what we need new models. I think we like ERC20 as shares. I think it needs like a completely new model. So like you need crypto native models. You can't like view them as shares because they're not just shares. So it's like an ERC20 could be a share, but it also could be like a very different thing. So I think a completely new model. And yeah, it is more VC-based investing. Ivan, protocols innovation, yeah. What's up, Roddy?
I think Ivan just a comment here is a really good point about a very competitive business space. Since the code is open source, it actually is a really novel point, right? Like you never really have this landscape where you can literally just fork competitors' code, but what you do with it matters more than the code itself. I think it's actually a completely valid point. And why you can describe value to innovation over just cash flow.
That is a good point. That's like Rory, no?
Yeah, Rory. Yeah, I mean, because their whole code is, I mean, the Fuse code is from Compound.
Yeah. Okay, nice. Yeah, what's up, Roddy?
Yeah, I was just gonna ask if there was kind of any other asset class or kind of anything in history that could be comparable to these rising token prices and how like DCF doesn't apply for crypto right now just based off of the kind of rapid adoption and speculation. So then it becomes more narrative based than on like traditional fundamentals. So it's like, is there anything else that we can easily point to? Probably not as big, but where this has kind of happened.
Wow, I don't know. I'm trying to think. Like crypto is a pretty unique asset, like tokens and stuff.
I guess what comes to mind is like maybe when like the early days of the stock market, once it opened up to kind of like the masses and like non-accredited investors or whatever that looks like, maybe there'd be like similar patterns shown, and then maybe there could be some correlation to what happened then to prices and to crypto now. But I don't know. That's what I'm asking.
Yeah. I think that like a little bit of the issue with like tulips. No, so like when you create like a DCF model, it's good for like companies in that like stock price fairly reflects cash flow. Like business must make money, so the stock price will reflect this thing. So like that's fine, but like in crypto, like there's the use cases of the token I feel extend much more than the cash flow that it generates. In that, like you look at like some of the tokens, they don't even have any cash flow going to them, but they're like worth a lot for like governance, or they serve some other need or like something like that. So I genuinely think that the models must just be new.
So like I guess also on Jason's point of like that's probably what comes to my mind as well, is like the .com bubble. And then, but then I guess like the follow-up question to that is, then is crypto right now just an equivalent of the .com bubble? And is, I mean, I know we said earlier that, you know, the curve is not overpriced in this, then the DCF model is not appropriate because there's other uses. But I don't know, I guess I'm just challenging that notion of like, you know, holding equity, you get shareholder rights, which is basically equivalent to governance, although it's, you know, slightly different. And is that difference enough to, you know, shift our typical ratios farther? Or
I think to consider is also that like anyone can create a token, and if you buy that token, just a single token for like price oracles play a big role in this too, right? But like the reason we're seeing these prices pump so crazy and seeing 1,000x's and whatnot is anyone can create a token. If they're willing to pay 1,000% more for that token than you did, then that creates the illusion of this huge market cap, right? But that's not a real, like, that's not based in anything.
Yeah. Yeah, I guess we can all like just discuss. I basically, just to wrap up this thing, I've said all that I needed to say. Yeah. Actually, I think, yeah, do you guys have, if you want to discuss with each other, I'm kind of like dead. So I'm pretty finished. Yeah, but if you guys want to like chat, if you want to like ask me, Jason, anyone else, anything, you can go for it. If you have any ideas. Yeah.
I have a question. I was just curious. Every 4 years, I think there's a halving for Bitcoin, and we were talking about like I don't know, time horizon for owning cryptocurrencies, but every 4 years is a halving, and then after that halving, there's usually a spike. Do you think that every halving up to like the last one is already priced in, or do you think that there's kind of like,
yeah,
like, I don't know. I mean, assuming that there were ones in the past, like spikes in the past for after every halving, it would seem like the prudent thing would to price in every single one, but I don't really know if like that's kind of.
I don't know if you were here for the halving itself, 2020, but like
Yeah,
when it happened,
yeah.
Do you remember like what happened on Twitter after the halving happened? So
no, not at all. No.
it was the exact same thing. So the thing went from I was at like $6,000 I think Bitcoin,
Yeah,
and then
like 30.
Yeah, but like at 6,000, it took a long time to get to 30, right? It went 6,
Yeah.
and then it went 12, and then it went 9, and then it went like, and then I remember when it was at like 7, everyone was like, this thing is priced in, the halving is priced in, which is like such a weird notion in that there's like few assets in the world that have such a big, such a lot of liquidity and like such a big supply chain, and that like you can't price in something like that. So the price goes up because of supply and demand nature, rather than people speculatively pricing in a Bitcoin halving. Because the halving, I guess, makes it more valuable, but it more affects the market nature of Bitcoin than the value of Bitcoin.
Yeah.
Yeah.
So is there a case where maybe you could assume like if there's more users in the future, regardless of like, I mean, I don't know if how much activity plays into it or volume, but I would assume like Bitcoin's future is nowhere but up, or I guess that's also kind of, you can argue a point against that, but yeah, never mind.
No. It's a good point. So like, is the next halving priced in? Is like, like, are we going to expect like a big climb after? I think no. I think we can expect like a large price increase. So like I am very Bitcoin bullish in that, like, I think it is one of the few things of immaculate conception, and I think just like the fundamentals of this thing are so good, in that I genuinely see it like absorbing gold and all of that. So do I think it's priced in? And I think like, I don't know, $1 trillion of value is priced in the next Bitcoin halving at 40 odd thousand K. I mean, I don't think so. And
I
I
have
also,
a vote. Wait, sorry. I didn't mean to cut you off, but then if you think it's going to spike up and the rest of the crypto market typically follows with Bitcoin, does that mean you think there's going to be like a flood of capital in all the crypto market, like with ETH as well? Sorry to cut you off.
yeah. I mean, I think so. This is now just like, I guess me chilling, I guess. So it's fine.
Sorry.
That's okay. Yeah, like broader thesis, I think Bitcoin acts very similarly to gold. I think it's the best way to explain all of that. And the money flows are definitely Bitcoin into other altcoins. And it does work that way. However, we now see a lot of like value flow into crypto through like raises and like all of these new protocols starting off. So I mean, I don't know how much longer that goes on for, but yeah, I do think that the broader crypto market does well under a increasing Bitcoin. I think that there's an interesting like point in so let's say that we get dystopia and we have like a hyperinflationary regime, right? And like people now flood to Bitcoin in Satoshi's vision. The thing is like inflation is, I don't know, 55% a year. It's like insane or something like that, right? And then Bitcoin is now serving its role as being hard money. I think in that kind of scenario where like you need something like as inflation dependent as Bitcoin, I think in a narrative like that, it does. I think only Bitcoin does well. And I think like few others do well, but that's like in dystopia and in the limit case. So yeah, that's my thought on that.
Okay, thanks. And then where can I find the recordings of the meetings?
They are on YouTube. They're also in the there's a channel on the Discord where the YouTube links are posted.
Okay, thanks.
But okay, guys, does anyone have any final comments? And then we can wrap it up.
When you stop the recording, could you leave the meeting open for a minute or two?
Yeah, I bet. Let me stop it now, actually.